Welcome to the Explainer from FinVot Insights. Today, we're going to tackle a subject that sits at the very heart of investing. It's a concept that every single one of us has to get to grips with, but one that many people find, well, a little intimidating. We're talking about investment risk.
This quote right here really is the foundation for our entire discussion. It's a simple idea, but it's powerful because it flips the script on how we usually think about risk. Instead of viewing it as something to run away from, it frames risk as the cost of entry. It's the price you have to pay if you want a shot at earning meaningful returns.
So, let's get a clear definition on the table. What are we really talking about when we say risk in the world of finance? At its core, it's simply the probability that you won't hit your investment goals. I particularly like this phrasing, the chance of disappointment. That's an excellent way to think about it because it makes risk deeply personal. It's not some abstract number. It's tied directly to your goals and your expectations.
In this first section, we're going to dive into this fundamental trade-off. The idea that risk is essentially the price you pay for the potential of return.
Now, this is a really powerful way to reframe your thinking. Stop looking at risk as just an unwanted side effect of investing. Instead, think of it as a resource. Just like capital or time, it's a scarce resource that you must spend strategically. You have to deploy a risk budget wisely to generate the kind of returns that build real, long-term wealth.
So before we start analyzing all the different risks out there in the market, we need to take a step back and look inward. This is absolutely crucial. And honestly, it's a step that so many investors skip. You have to understand your own personal tolerance for risk, as it's the bedrock of any solid investment strategy.
Your overall risk tolerance is actually made up of two distinct parts. First, there's your willingness to take risk. This is psychological. It's about your personality and your past experiences. Can you sleep at night when the market is volatile? That's willingness. But then there's your ability to take risk, and this part is objective. It's about the numbers, your wealth, your income stability, and, critically, how long you have until you need the money. A successful investor must be honest about both. You might be willing to take huge risks, but if you lack the financial ability to withstand a serious downturn, that willingness becomes a liability.
All right, now that we've looked at our personal tolerance, let's turn our attention outward. We'll build a kind of field guide to the main types of risk you're going to encounter as an investor.
For the most part, we can group the major risks that can affect a diversified portfolio into these four buckets. You have market risk, the risk of the entire market declining. Then there's credit risk, which is the risk a borrower won't pay you back. Liquidity risk is about your ability to sell an asset quickly without taking a big price cut. And finally, operational risk covers all the things that can go wrong behind the scenes. Understanding these four provides a solid framework for analysis.
Let's start with market risk, because this is the big one that affects everyone. This is the risk that the whole system, the entire market, takes a dive. It's driven by broad macroeconomic factors. Think changes in interest rates, economic recessions, geopolitical events, or even just a major shift in investor psychology. And here's the key. Because it's systematic and affects everything, you can't just diversify it away.
Next up is credit risk. If you invest in bonds or other forms of debt, this is your primary concern. It is simply the risk that the borrower, whether that's a corporation or a government, will default on its obligations. This can mean they miss an interest payment or, in a worst-case scenario, fail to return your principal when the bond matures.
So we have these categories of risk, but how do professionals actually attempt to measure it? Let's pull back the curtain on some of the key tools they use to try and put a number on uncertainty.
The most common starting point for measuring risk is a term you probably remember from statistics class, standard deviation. In finance, it simply measures how much an asset's returns tend to bounce around its historical average. A high standard deviation means the price swings are wide and unpredictable, which signals higher risk. A low standard deviation, on the other hand, suggests more stable and predictable returns.
This chart brings that concept to life perfectly. You can see very clearly that different asset classes have inherently different levels of volatility. On the far left, cash is incredibly stable, with volatility of less than 1%. Government bonds exhibit a moderate level of risk, around 8%. And then you see global equities, showing the highest volatility at around 15%. That increased volatility is the price an investor pays for the potential of higher long-term returns.
But here's where it gets more complicated. Relying only on standard deviation has a major blind spot.
This quote nails it. Most traditional models assume that market returns follow a predictable, normal distribution, a bell curve. But what about those extreme, unexpected events, the so-called black swans? Well, history shows us that they appear far more frequently than those models would have us believe.
And this isn't just a theory. The data proves it. This table compares the actual history of the S&P 500 against what a normal statistical model would predict. The model says a massive one-day move of more than 4 standard deviations should be almost impossibly rare, happening less than once in this entire period. The reality? It has happened 9 times. We've even seen 5 and 8 standard deviation events, which, statistically speaking, should be nearly impossible.
This discrepancy is known as fat tail risk. The tails of the distribution curve, which represent those extreme outcomes, are much fatter in the real world than in the theoretical model. The crucial takeaway for you as an investor is this: catastrophic market crashes and spectacular rallies are simply more likely to occur than standard financial theory suggests. Acknowledging this is vital for building a truly resilient portfolio.
So if standard deviation has its limits, what else do professionals use? One powerful tool is stress testing. This approach moves beyond abstract statistics and asks a very practical question. How would my specific portfolio hold up if a major historical crisis happened all over again today? Analysts will simulate these kinds of past crises, applying the market shocks from those periods to a current portfolio. Now, this exercise doesn't predict the future. No one can do that. Its real purpose is to reveal hidden vulnerabilities and concentrations of risk that might not be apparent from a simple volatility calculation. It helps answer that essential question: what is my realistic worst-case scenario?
Finally, let's bring all these ideas together into one practical framework. Perhaps the most important lesson in risk management is that not all risks are created equal, and a sophisticated investor knows how to tell the difference. This is a critical distinction to make. Good risks, like market risk or credit risk, are what we call compensated risks. The market over the long term pays you a premium for your willingness to bear them. Bad risks, however, offer no such compensation. There is no long-term reward for taking on the risk that your broker's computer system fails or that a fund manager commits fraud. These are purely negative, uncompensated risks that should be minimized or avoided.
So the goal of modern risk management is not to eliminate risk entirely, because doing so would also eliminate your returns. The real objective is to intelligently construct a portfolio that is deliberately exposed to those good, compensated risks while rigorously working to avoid and mitigate the bad, uncompensated ones.
And so we'll leave you with this single, powerful question to apply to your own investments. Look at every holding in your portfolio and ask yourself, which risks here am I truly being paid to take, and which are simply unrewarded dangers? Thank you for joining this explainer from Finbot Insights. If this helped you become a more informed investor, please click like and subscribe for more content designed to do just that.